Hello and welcome to the Asset Allocator podcast. I'm Simoney Kyriakou, editor of FT Advisor. In this week's episode, we're going to be looking at two shocks, one boom, and the investment multiverse. Is there life beyond developed markets? Is the AI boom really a bubble? And what is happening in terms of supply and demand shocks? Well, here to discuss all these things and more is Joe Little, Chief Strategist for HSBC Asset Management. Welcome back, Joe.
Hi, Simoney. Great to see you.
Great to see you too. Now, two shocks. Could you please describe what they are? And I'm sure there are more shocks than that happening right now, but...
It is occupational hazard for investment strategists to try and come up with jazzy phrases and jargon in their mid-year investment outlook. So that's what I've tried to do. But you're quite right. Two shocks and a boom is one of our phrases in our mid-year outlook. And the two shocks really reflect two big supply disturbances that are affecting the economy, growth, inflation, profits right now. The first one is what we see in terms of geopolitical uncertainty. So geopolitical uncertainty, obviously the situation in West Asia is front of mind for everybody at the moment. That's created a lot of volatility in commodity markets, Brent, West Texas oil prices, agricultural prices, natural gas prices, all shooting higher and showing a lot of volatility. And that sort of ripples through into headline inflation, into core inflation. So that has a big effect in terms of the inflation situation, even if it doesn't necessarily keep going, the so-called second round effects. And the second shock is what's coming out of China, which is this new export wave of advanced manufacturing. You may have seen now China EVs increasingly on UK roads, increasingly popular, and a little bit like what we saw in the 2000s and the 2010s when China joined the World Trade Organization and we had this big wave of labor-intensive exports coming out of China. People said, oh, China's exporting deflation to the rest of the world. We're seeing the same pattern again, but this time with advanced manufacturing. So electric vehicles, renewables, batteries, solar cells, these sort of areas. And that has the opposite effect to the geopolitical uncertainty and the commodity volatility. It lowers goods prices. And then the sort of third part of the story, the boom part, is what's going on in AI. Yes. And that's adding, as an investment story, that's adding a lot of extra demand on energy, electricity, compute prices going up. So that adds a bit more inflation pressure. But of course, if you look a bit longer term, it maybe dampens inflation situation with a big productivity effect. So it's a bit all over the place with the inflation pressures in some parts of the economic story pulling inflation higher and in other parts pulling it lower.
Yeah, so how can investors then make sense of this? I mean, what do they then do in terms of sort of inflation-proofing portfolios?
Well, the first thing is it's quite confusing and complex.
Yeah.
So maybe we should acknowledge that and not put ourselves under too much pressure to think precisely about how the inflation situation is going to play out. I call it spiky inflation. And I think what it means is that the inflation situation is certainly more volatile. And probably also the resting rhythm of inflation is a little bit higher. But it's not the 1970s because some of these forces are pulling inflation lower as well as others pulling it higher. And it's also not that obvious that things are that persistent. So, I mean, as always, a good strategy is diversification, thinking really broadly about how you build portfolios, thinking about some inflation hedges as part of that story. Sometimes I like to say diversify the diversifiers. Just think really broadly about the investment universe and to take into account some of those inflation strategies, inflation hedges like commodities, like real assets into how you build portfolios.
Coming up, what's the story for emerging markets? Find out after this short clip.
Opportunity is everywhere. Access is everything. Access is expertise, guiding you with local insight. Access is discipline within a diversified approach, from traditional asset classes to ETFs and alternatives. Access is connection across a global footprint. Because when the world of opportunity is truly in reach, access is everything.
Now we're going to come on to emerging market economies a bit later, but let's talk about AI because we recently had the new listing of SpaceX, which is very exciting. That sort of sent a rocket up in the markets, to coin a phrase. And then, people are discussing, there's lots of headlines now about OpenAI and, what's going on and the valuations there. Are we sort of seeing a next wave of tech companies, or are we looking at this real classic bubble scenario?
Yeah, and don't forget, it's not just the Mag 7, Mag 7 Plus, the Nasdaq. It's the Philadelphia Semiconductor Index. It's the stories in East Asia with the semiconductor manufacturers there, Korean stock market, really performing incredibly strongly so far in 2026 and over the last 12 months. So there is a real key theme around the AI tech boom, and everywhere I go, traveling, meeting different investors. I was in Asia. I've been in Asia over the last couple of weeks. The first question people ask is it a bubble? What happens next? It's on the top of everybody's mind. So it's a great topic. When we look at market prices and market technicals, it certainly looks quite frothy at this juncture. I mean, you only need to take a look at some of those indexes that you mentioned that we talked about to see a real frothy, parabolic dynamic in market prices. So that's a little bit of a warning sign. And with the mega IPOs that you mentioned, this is also a later cycle signal.
Right.
Insider selling tends to be something that happens as we're progressing through the bubble process. But I think some of the other elements that we might focus on, like the scorecard maybe that we might focus on to work out if we're in a bubble, some of those other factors maybe aren't sort of flashing red in quite the same way. So the first one might be liquidity. In the 99-2000 TMT.com story, we had the Fed tightening rates really aggressively, pulling liquidity out of the system. Yeah. The IPOs that we're seeing aren't draining so much liquidity, and the Fed's sounding a bit more hawkish. We had new Fed chair sounding a little bit more hawkish, but they're not hiking rates in the same way that, Greenspan hiked rates 175 basis points. 99, early 2000. So we're not at that stage yet. The bond market's not doing that much tightening. So liquidity conditions look still supportive, we think, for the AI story, but probably important to be selective at this point.
Absolutely. And I know that momentum has been so popular with investors and people just sort of buy an index and stick with it. But one of the things that when you really get under the skin of AI companies, a lot of them are saying, well, all the other companies have been testing AI tools, but now they're starting to commit. So they're actually putting money for a sort of 12 or 24-month period behind actual tools that they're now implementing. And that take-up is growing, but it's still relatively small. So the actual products, if we can call the AI a product, there's still some kind of growth and still some kind of measure there. So the companies are still going to see long-term income streams from these, whether they're a very small company thinking about an AI tool to kind of make their admin better, or sort of large-scale corporates looking for something to completely revolutionize their service propositions. It looks like there might still be some kind of actual product in the system and a good pipeline.
Well, the order books look full. 12 to 18 months for chip manufacturers, 12 to 18 months order books. There's good visibility around that for investors and the corporates themselves. Those order books are chock-a-block, full up. A lot of investors I meet have some concerns about what the return on investment is going to be from the massive capex spends that are being announced. So the US hyperscalers have talked about $750 to $800 billion worth of capex over the next 12 months. That's quite a lot of money. And there is a legitimate question about how much of that is going to deliver a good return for investors. But for the time being, like you say, I think the data on US profits is still confirming the idea that there's profits delivery. Yeah. About 70% of the latest quarterly profits round in the US has been about the AI and tech sector. So it's still very much keeping the show on the road in terms of profits delivery. And that's a really important part of the story, because when you start looking at historic valuations, maybe something like price to book value, Nasdaq's on about 9 times. So it's the forward multiples that are maybe giving you a cause for calm and a sense that the story can continue to run, because as that profit's delivered, we can see much lower profit price to forward earnings, forward profits valuations, and that's a really key part of the story, because we don't see yet the same sort of frothiness, bubbliness in valuation multiples like we saw in previous cycles.
But let's move on to emerging markets. I mean, you touched earlier on Korea with its amazing semiconductor and its really good tech growth. India's been showing great tech growth, and then China is really coming out of the out to the field, sort of racing ahead in EV sales, battery sales. What's the story for for emerging markets? Are we seeing this good resurgence now?
Well, some of the themes that we've already mentioned are also relevant in the context of emerging markets. So it's a bit lopsided in terms of market performance. There is a concentration, dispersion. In some markets, that's even more marked in emerging market indexes, emerging market countries, than what we see in developed markets. The East Asian tech names first and foremost. And that creates a bit of a sort of a regional divergence in performance. And North Asia outperforming South Asia, LATAM performing well because of the commodities story as well. But the broad index continues to be performing very strongly, outperforming MSCI World, 30% versus about 10% so far in 2026. And I think the outlook looks quite promising. Forward multiples are around 12 times for emerging markets. And although you've got concentration in tech stories, there's something of a balance because you have, on one hand, those tech companies delivering profits and offering a good momentum story in markets. And on the other hand, the commodity producers in Latin America, which are, of course, a big part of the upstream story with AI in terms of producing copper and energy and all of the other input components that are needed to build out all of the new tech economy. The other aspect, of course, is the dollar. The dollar's been a little bit stronger in 2026, but not to such an extent that it really chips away at the EM story. So a couple of percentage points of higher dollar on a trade-weighted basis. And some of the emerging market currencies, of course, have been very resilient, despite the fact that we've had all of the geopolitical stuff going on, despite the fact that we've had a bit more of a hawkish Fed of late. I mean, even in the midst of the worst moments of volatility with the episode crisis in March and April, we still saw a handful of emerging markets outperforming the dollar. China, Kazakhstan, Colombia. So you have to look a little bit closely, but then they've bounced back very quickly. So the currencies are still working for investors, and the equity market stories anchored in tech and in materials is also performing.
Are we sort of almost, though, overlooking the fact that they are still very, very, very risky because a lot of the world's most totalitarian regimes are in emerging markets? That's always going to be a threat, isn't it? Particularly in frontier and emerging markets.
Well, clearly with these things, you've got to go in with your eyes open. But what we've seen over recent years is emerging markets' ability to navigate financial volatility, economic slowdowns, geopolitical events has been
political coups,
incredibly impressive. So there's a resilience there in the asset class, which is quite new. And I think under-acknowledged by investors. I mean, historically, we've often thought about emerging markets as just being a play on the Fed or a play on the dollar cycle or play on global liquidity. We've thought about them as being risk on, risk off, a bit like Karate Kid, risk on, risk off. But those characteristics seem to be less and less important as part of the story now. And in fact, combination of economic reform, the local capital markets becoming deeper, and maybe a sense of investors becoming more comfortable with some of these ideas as investment themes has really moved the story on. So you do see this much more resilient behavior of the asset class, a tendency for it to be able to bounce back from shocks. And also, I mean, stunningly, really, much lower levels of volatility than you'd expect.
Yeah.
And that's true even in the frontier market index.
Doing really well. I'm very excited with Vietnam going to be moving up into the emerging markets index.
So there's a lot of really good stories in the frontier index, and maybe we can dive into it in a future discussion in a bit more detail. But you think right across the Gulf, South Asia, the European zone, a lot of really interesting stories. And what's interesting in particular is how different they all are. And from an investor perspective, that becomes really valuable because you've got then these regions, countries, weights in the index, which are unrelated to each other, decorrelated, and then dampening the overall volatility, experience, turbulence that we experience as investors. So a really important new attribute to thinking about investing in emerging and frontier countries.
Yeah, and that goes back to the point you made at the beginning, which is about diversification. There is life beyond developed markets, and we need to be diversifying portfolios across everything.
Yeah, exactly right.
Well, thank you very much, Joe, for talking to us.
Thanks a lot, Simoney.
And thank you for watching. Don't forget to subscribe to the Asset Allocator podcast in all the usual places. Until next time, take care.